the moment they make money, there is a bias that comes in for most of them is the house money effect. Some people don't even enter the equity markets fearing that they will lose money in the market in a correction.
Okay.
The amount of pain one feels in a loss of 100 rupees is almost double that you feel, the happiness that you feel at the profit of 100 rupees.
Exactly.
Doing a scenario analysis like a bull bear case helps you understand the risks of an investment, and it is okay to understand if there are some risk in the investment. Now you know when to get out of it and see which is the best risk reward that you get. Another simple tool is journal.
Okay.
Whenever you take a decision of buying a certain asset, making a certain investment, write down a few lines on that day, why did you take that decision. What I would still suggest people is, even if you are using one particular measurement for the market, take a longer term data, and second, there is a method called anchor and adjust.
Okay.
So anybody can be a good investor, and India is at a position where this country will create huge wealth. These markets will create huge wealth for people.
Welcome back to Wisdom with Vinsan. I'm your host Vinita Kejriwal, and my episode name is Behaviour Creates Alpha. That can also give you a perspective the way you think about investing. When it comes to alpha, most of the time we think about the investment returns which have been created over the benchmark. And generally, the fund manager plays a pivotal role in creating such alpha. What if I say that your behavior also creates alpha? Yes, the decisions you make, the emotions you feel, and the biases you carry, all these actually gives a change the way you think about investing. And who other than my guest in this episode can take us into this fascinating journey? Mr. Nimesh Chandan, who is the CIO of Bajaj, Vinsan, and also who is having an experience of more than 2 decades, not only about managing funds but also understanding what successful investing means. Welcome Nimesh to my episode, and it's my pleasure to have you here.
It's a pleasure to be here.
Absolutely, when we often talk about investing, it's about the strategies, numbers, markets, but we actually forget about behavior. So let's take a deep dive into it. So Nimesh, I need to start with, when we talk about investing, the mindset and the numbers equally play the role. So tell me about the traits of a successful investor which set them apart from the average investor.
So there are many studies done on the success factors or characteristics or traits of a successful investor, and obviously a lot of great investors have been studied. 3 things you will find common in them. The first is a long-term perspective. That they look at investing over a longer term and benefiting from their ideas. The second is they follow a process or a system of investing with discipline. So that gives them an edge over the others.
Okay.
I think the third important thing is that they understand markets very well. They do their research about not only the companies but also the market behavior. Now, if we take a common thread among all the successful investors as I see it, is that they have a behavioral edge.
Okay.
They are able to understand what biases impact decision making, and they try to avoid those behavioral mistakes. At the same time, they understand the market behavior and they take advantage of the market's behavior. I think behavioral edge is the differentiator between the most successful investors and the average investor.
Okay, like you rightly mentioned that behavioral edge gives the kind of the edge to the investors who can be really successful in their investing part. So coming to our a follow-up question. When you talk about the market sentiments, you should also have experiences how that actually have a difference to the investing pattern, because when you see the markets are soaring, people actually tend to buy, maybe move, and when the markets go down because of the maybe panic button, they tend to sell. So don't you think this affects their investing style? So what should be their approach to this?
So market is a combination of 3 or 4 cycles, as we put it. One is the economic cycle, the profit cycle or the corporate growth cycle. The third is the credit cycle, which is related to banking and the financial system.
Okay.
And the fourth and the most important is the sentiment cycle. The first 3 form part of what we call as fundamental research. At Bajaj Finserv AMC, we also do sentiment research or behavioral research on the markets. Typically, markets have a certain pattern where the best representative I can use for this is a pendulum, and you would have heard that quite often.
Right.
That markets swing between greed and fear.
Correct.
Though the fair value of the pendulum will be at the center, they spend the least amount of time at the center. They keep moving on
From
that.
you, right.
Bull markets make people greedy. They want to make money quickly. They also have fear of missing out. They hate keeping cash. And when market is in a fear, and the recent episode was the COVID time,
Correct.
where people have loss aversion, people have fear that they will lose money if they invest right now, and liquidity preference goes up. So now they want to stick to their cash as long as possible till they are very sure. And these cycles keep repeating within an asset class and across asset classes. So one must understand the sentiment cycle of the market to be a better investor. Bull markets, I believe, are a combination where fundamentals are also doing well and the sentiment is also extremely positive. And there are markers to it which should tell you that whether markets are moving into greed or fear. During the conversation, maybe I can refer to some of those biases that come into decision making. But a sentiment cycle is an important cycle to understand.
You rightly said about this pendulum example, because so it's from here or there, and most of the time it's not at the center. So the pendulum keeps on going from here and there. So it's also about the bull markets, or it's per se any of such markets. So the investor actually has to understand, rather again the behavior comes into the, when you're sitting, we cannot forget about talking behavior all the time, because you're the one of the veteran who always talk about how the behavioral science is so important for your investing part. So even now, then talking about some emotional part which you mentioned. So coming to the kind of the new investors. Now you would also agree. I mean, since COVID, the number of the investors who have come into this market have been at the peak. So that means the investor coming this point of time, having witnessed the downside, is huge. And also, thanks to all those apps and a lot of platforms are available, and even the social media information, which at the same time, it's again very overwhelming, right? So it's at the same time confusing at the same time, right? So tell us one thing, how this new investor should have their approach to this investing style, and what are the ifs and the buts they should take into the account before investing.
So let's look at some of the common characteristics that are seen in new investors who come into the market. Whether you look at US, whether you look at India or some of the other Asian markets, when new investors come in, it's typically during a bull market.
Right.
So they come with a buy bias. They always obviously open an account to buy something. Nobody opens a new account to short in the market.
Exactly.
So bull market attracts a lot of people, and the pace of the bull market makes people feel that money can be made easily in anything that they buy. They also trade more typically. Typically, the new investors who come in have an average age of about 30 or 31. So
those are the people who are very young in between, kind of the ones actually.
So a young crowd comes in because they have not seen the past.
Exactly.
Or studied the past cycle most of the time. they believe this trend will continue. So they are in a way trend followers.
Okay.
They also rely a lot on what is being discussed in the media, in the news, in say social media. So they typically chase hot stocks, or they are interested in stocks that are being discussed. And the moment they make money, there is a bias that comes in for most of them, is the house money effect. You will find that gamblers, when they go into a casino, they actually divide their money into two accounts.
Okay.
One is their own money, which they brought to the casino, and second is the profit they made at the casino.
Okay.
So that is called the house money. So I have taken from the casino house.
Okay.
So that is
I was
kept in a
thinking, what does
separate
that
pocket.
mean actually? Are they bringing that from the house or something? So they have divided that profit
Yeah.
part maybe to keep aside. So maybe they can bet more or something kind of,
You exactly pointed the characteristic. Typically,
Yeah.
people take more risk with the profits that they have made
Correct.
than their own money. So they become more fearful if they are making losses.
Right.
But when they make profits, they become a little extra risk takers, which somebody would say, why not take extra risk with the profit that
Anyways,
you made?
this
It's
you
okay,
have
it's the money that
yeah,
you taken from the
actually.
casino. But that's not how you create wealth.
Correct.
Because by taking extra risk, you will keep coming back to the same amount. Whatever you
Exactly.
win, you will lose back by taking higher risk.
You cannot come out of that vicious circle.
Yeah, so
you
then
get
you
trapped.
will forever be at a certain layer of wealth. You will not be able
Exactly.
to expand your wealth.
Very true. So I mean, that's very rightly said. We can apply to this investing part as well. Most of the time when investors start their journey, maybe they start with the risk appetite selects A. But once they have made money, they say ki chalo isko book karo and let's get into some more aggressive funds.
Yeah.
Though that can apply to their psychology of investing as well.
Absolutely.
So coming to my again follow-up question, so like you mentioned, ki that was one part of the investing, but most of the time there's one obstacle which comes in between if you're investing, which is a fear. That fear maybe of losing money or maybe, taking wrong decision. So tell me what kind of approach an investor should have for the investing?
So whenever you put money on anything, our emotions get attached to it. So even in investing, it's difficult to keep emotions out, because you're investing money, you're hoping that you will make certain money and you will have dreams about how you will spend it. If you make a loss, you feel, oh, I should have done something else.
Correct.
So a lot of emotions come in. Fear is a very strong emotion that comes in. And
So fear is also emotion, you mean?
absolutely.
Okay.
It's the strongest emotion, I would
Okay.
say. And human race survived because of fear.
Okay.
So if our ancestors, if they heard a lion roar in the woods or see a tiger and they did not run out of
Correct.
fear, then possibly the race would not have survived.
Right.
So fear is an important emotion. It's difficult to control fear, and fear also depends on your perception of risk. Some people don't even enter the equity markets fearing that they will lose money in the market in a correction.
Okay.
Say 20% they will lose if they enter the market.
So they
at a
want to be
correction time.
sideways from the market.
They stay away from the market.
Okay.
But they don't see that the whatever 6% or 5% inflation in the market is slowly taking that money out of their pocket.
Exactly.
So fear is about also your perception, how you are going about. So learning about markets, participating in the markets in the right way is important. To control fear, you in the shorter term, it is okay to just step back a little, calm yourself down, talk to people who are calm and come back to investing. The other way to look at it is, in your investment process, put certain pre-commitments that stop you from acting in panic.
Okay.
So that helps in controlling fear.
Correct. Very rightly said. Like you has mentioned, some takeaways. Talk to the people who have that calmness when you're talking, because once you share, communicate, maybe that can take to you in a different way. So maybe your advisor or anyone else who can navigate through all these. So very rightly said. So coming up again for my follow-up questions, how can I forget, talking about biases? So we all experience about these biases, and we all want to be very rational, very logical, but you would agree to it that, your brain takes over it. So tell me some your favorite biases which actually help the investor so that they can take a very calibrated approach to their investing.
So I would start by saying that when we study behavioral finance, and at Bajaj Finserv AMC we use behavioral finance tools in improving our decision making a lot. Behavioral finance says that people are normal. Traditional economics put people as robots, like they are perfectly rational, they take all decisions without any emotions. Behavioral finance takes people as normal, that yes, there are certain emotions that impact us, and in life there are many emotions that help us get through life, but they may not be right in terms of investing. 4 common biases, if I can say, that impact decision making of investors, traders as well as professionals. First is confirmation bias. Here people try to collect that kind of data that confirms their already established views. Okay. If I bought a particular security, I will try to find data which confirms that this is the right decision.
So that's what confirmation bias. Okay.
And I will meet only people who agree with me. I will not probably listen to people who are saying
have
something
some contrarian kind of view or some kind of.
So confirmation bias is harmful because then you don't understand the risk of the investment. The second bias is overconfidence, and that's in a way related to confirmation bias. Overconfidence means if I'm going right, I believe that I cannot go wrong. I believe I know much more than what I actually know.
Exactly. Okay.
Overconfidence makes one take more risks. Like people moving to leverage or trading in futures and options and so on. Confidence is important, conviction is important in investing, but overconfidence is harmful.
Okay.
I would say the third one is loss aversion. If people hate to take losses. There's research that shows that the amount of pain one feels in a loss of 100 rupees is almost double that you feel, the happiness that you feel at the profit of 100 rupees.
Exactly.
So it's easy to take profits, it's difficult to take losses, and loss aversion does lead to certain wrong portfolio decisions.
Okay.
And the fourth one is herding. People like to be with the crowd. Being contrarian is important in investing, and contrarian not just for the heck of it. You research well as to where the market has overreacted and you take an opposite stance. But most people are not able to stand a contrarian position because they feel they are against the crowd. The entire crowd is chasing one asset and I'm going against it. It's a difficult position to have. Mentally also, emotionally it's a difficult position to have. But herd mentality, which means you keep swinging like a pendulum with the crowd, will also not give you superior returns.
Right. We can keep on and on talking about these biases because I know that's your subject and you always give so much of importance to this behavioral part and the biases kind of, and if I'm not wrong, you have written a book also about this. Can you mention that name if in a way?
So I have written a book called Stoic Investor.
Correct, right.
Which deals with many different biases and I've tried to give some solutions to how one can be a better investor, addressing those biases, some simple tools that one can use to be a better investor.
Correct. So that was my follow-up question because again, but you I think mentioned in your this answer itself what should be the simple tools, so for a smarter investing. But I hope that you have again mentioned in this, or if you want to add something can be also done. If you want to add something can be any other tools which you have mentioned in, or there are any other ways.
So some of the tools that we use in understanding markets and taking better decisions, doing better research. First is looking at cycles. Every industry, economy goes through a certain cycle, and while people like to extend the Excel sheet and project more linearly, life is lived in cycles. So one should understand the cycles, understand history of investing. Second is to have some understanding of where the market is overreacting and where it is underreacting. Where people are working on greed and where people are working with fear. And try to take advantage of those. Simple tools like an investment checklist help you focus on which are the areas that you want to focus on before investing. doing a scenario analysis like a bull bear case helps you understand the risks of an investment. And it is okay to understand if there are some risk in the investment. Now you know when to get out of it and see which is the best risk reward that you get. Another simple tool is an investment journal. Whenever you take a decision of buying a certain asset, making a certain investment, write down a few lines on that day, why did you take that decision? When you're reviewing the outcomes, it is better to review with the kind
comparison of the results
reason that you have
exactly.
invested in.
And that's a very, very valid point also. When you write something, you have something documented so that it becomes easy. So what you thought, and when it's into your pen and paper, so that's really, very apt. Correct.
Yeah. So these are simple tools that anybody can use to be a better investor actually.
So very, very impressive that these are simple tools but can be used for your smart investing at the same time. So almost to the end of my episode, but one of the questions which again I would like to ask is, when you talk about the market valuation or when you talk about the sector performance, this is more about, now we are coming to the technicality or the practical part. So how should one investor has the approach to it? I mean, taking this into consideration before investing. So because it does matter. A lot of people do consider the market valuation and their impact on the sectors which are going to perform. So how would you perceive this?
So when we look at markets and valuations in general of the overall index like a Nifty, we don't go with only one particular ratio. Like most of the people go with price to earning ratio or maybe price to book ratio. We don't go with just one particular ratio. We try to combine these ratios and values into what is called the intrinsic value of the market, because some ratio works in certain companies and not in another set of companies, and that's why generalizing that market will be in a band in a particular ratio for a particular parameter is a bit asking too much. What I would still suggest people is, even if you are using one particular measurement for the market, take a longer term data, and second, there is a method called anchor and adjust to it. So say somebody tells you a simple example, price to earning ratio of Nifty is averages 19 times in the last 15 years and now it is at 21 times, so it is expensive. The data is correct, but what you should understand is 15 years back from the time when we are measuring, what kind of companies were in the Nifty? If they were more cyclicals, more commodity driven companies, more leverage companies, then they deserved anyway a lower valuation. Now, if the index itself has changed to sectors where there are high cash flows, structural stories, so you anchor on 19, but you adjust upward based on the valuations of the new sectors that are coming. So maybe then you will find out that 21 is actually a reasonable.
So you cannot take
valuation.
into isolation, right?
Absolutely.
So it has to be with other parameters and filters together. So it cannot be one at the time, right? So you wanted to share something more about this, or
No. So I believe investors who are investing, they need to understand four things in the market. One is understand obviously these market technicalities, like what valuation parameters are there and how to use it. They need to understand businesses. Before investing in anything, you should know what that business is. Third is the sentiment cycle or the psychology of the market. And fourth is history. Understand what cycles the market has gone through in different asset classes. So then you will understand where the opportunity comes in. So these four, I think, market concepts, businesses, psychology and history are very important.
It can be kind of a four pillar or kind of a four major filters before one decides or get into some technicalities. So I think they can consider these, right? So thank you so much, Nimesh, for sharing your wisdom over my channel, which is again Wisdom with Vinsan. And you rightly mentioned that, mastering your behavior with the market is only not the thing. Mastering yourself, oneself is really very, very important. And I hope the listeners who are listening to this conversation has actually got some kind of insights or some kind of practical takeaways who can actually, with which the investor can actually have some more calculated approach to their investing as well. So any last piece of thought or any last piece of wisdom which you would like to share with my viewers and the investors?
So anybody can be a good investor, and India is at a position where this country will create huge wealth. These markets will create huge wealth for people. If you understand yourself better, like you mentioned, and you understand the crowd behavior better, you will be able to take better investment decisions and create wealth for yourself over a long period of time.
Okay, so that means that over a long period one can make wealth without getting into any such of technicalities, or without getting into such kind of fear or something. So your goal is really very important. So the long-term investing, as we always mention, is again very much important for any of the investor who want to start their journey. So before we wrap up this episode, I would actually, this was a little surprise for you as well, want to take you through this rapid fire. So quick 5 questions, but you can't say pass to this.
Oh my God.
Yeah, it's very simple. So I haven't kept very technical, and you can answer. So nothing compliance also. Okay, I'll start because paucity of time is there. So what's more dangerous, fear or greed?
Fear.
Okay. That's right. As you mentioned, that's the emotion which is really very, very important. The hardest bias to overcome in investing?
Confirmation bias.
Okay, right. Which emotion hurts investor more? Overconfidence or regret? Because I remember you talked about overconfidence, but answer this question. Overconfidence or regret?
I think overconfidence, because it can lead you to actual losses. Regret leads you to opportunity lost.
Wow. So you have to the answers also justification. So nice. What's more powerful, market knowledge or emotional control?
Oh, emotional control.
Okay, so you are an emotional person. Do you think behavioral biases can ever be eliminated, or it is going to be pertinent all the time?
They cannot be eliminated.
Okay.
You can reduce their impact on your decision making to some extent.
Okay. So what's the best way to stay calm during the market volatility? Though we are just witnessing the upside, but that's part of the market cycle. One can actually witness the market volatility. So what should they do to stay away from this?
The simple thing is, have the right team of people around you, and you can go through market roller coaster much more.
You can mention that they should have some good financial planners with them, so that also they can stay calm.
The good
okay,
people.
Yeah, actually, I get that. What's more difficult to manage? Fear of missing out, that is FOMO, or fear of loss?
Fear of loss hurts more.
Okay. And my last question, what's more important for creating alpha? Because my episode name is Behaviour Creates the Alpha, but staying rational or staying informed?
Both.
Okay, so you can't say one for this, right?
So information edge is like table stakes. Behavioral edge takes you in gains.
Okay. Thank you so much, Nimesh. I can go on and on, but at the moment we have to cut this story short, and we are at the end of this episode. We are going to wrap up this, and thank you all for tuning in, and do not forget to subscribe my channel, because otherwise you're going to miss a lot of wisdom which can help you in starting your investment journey as well. Stay wise, stay invested.